Welcome to today's Corporate Venturing Insider series. Today, I'm very excited to have Talia from Deloitte Ventures. She started the CVC for Deloitte in Canada. Talia, welcome.
Thank you, Nicolas, for having me. Delighted to be here.
I'm very glad to have you and I think because you just started recently, there's a lot of design decisions and the why that's fresh in your mind. So we're going to spend a lot of time on that. But maybe first, if you can share your journey into corporate venturing.
Yeah, sure. I guess my journey is a non-traditional one, and I kind of fell into ventures, but I'll sort of take you back. I've been with Deloitte Canada, about 20 years. My background is in M&A, particularly valuations. I did valuations of technology companies primarily in the context of M&A, both buy and sell side. Got really passionate about technology, also really passionate about operations. I come from a family of serial entrepreneurs, more out of necessity, nothing really sexy or innovative. They were retail stores, but nevertheless, I worked in those stores from the age of 7, and so did my whole family. And so I always had this entrepreneurial gene in me. And while I was working at Deloitte, I always had a business case on the side about the company that I was going to start. And naturally, when you're doing M&A, you get soaked up into a project and you're working 100 hours a week and you have no ability to do that. And I always found that at Deloitte, I had really the opportunity to be an entrepreneur within Deloitte. And without taking the significant risk and with having tons of resources. And so I took on a role as chief operating officer of our financial advisory business. In my 20s, it was a $200 million business at the time, and I got to run and manage that business. And so really satiated my hunger for running an enterprise. And then after that, I co-founded the artificial intelligence practice at Deloitte Canada called Omnia AI. We scaled that practice to about 500 people in 24 months, which was
Wow.
just amazing. So got to sort of ride the scaling journey as well. And then we agreed that once we sort of scaled that business, we would seed it back to one of our existing businesses. And so we did that. And I was looking for my next adventure, both within and outside the firm. And the CEO of Deloitte Canada tapped me on the shoulder and said, "Hey, we've been talking about this venturing thing for a couple decades now. Could you maybe spend a few months digging into it and making a recommendation, working with our executive leadership team on what this would look like if we do it, should we do it, et cetera, et cetera." And so I just immersed myself into this ecosystem and learned everything that I could. It was much less a desktop study and much more sort of involved, and got super excited and passionate about it. And needless to say, the recommendation was we should proceed, and here we are. So today I manage that fund, and it's a $150 million fund that we launched in January of 2022. So we're about 2 years into this journey.
And this morning, I saw a LinkedIn post from you showing that you're on the list for Canada CVCs.
Yes. So the CVCA, the Corporate Venture Capital Institute for Canada, launches a report every year on the activity that happens in Canada. And so they've got league tables for different categories of VCs. And yeah, we're, I think, number 4 on the league table of corporate VCs and pension funds in terms of activity, which is, just wonderful to see 2 years in.
Very, very nice. You say you've been immersing yourself, so maybe you could share with the audience who are thinking about starting a corporate VC, what materials, resources did you find the most valuable to you?
Yeah, it's a good question. I mean, it was a different market at the time that I was assessing it. I was assessing it from the standpoint of, could we stand out in a market where deals are being done really quickly, where there's sort of tons of capital, what was going to be our differentiating proposition. But what I found really valuable actually was the naysayers, sort of immersing myself and getting really familiar with why corporate venture doesn't work so that you could really build for success. I spent some time with Josh Lerner at Harvard, following a review of his piece, to just better understand, what he's seen work since then, et cetera, et cetera. So I think that was the most informative to me in terms of standing one up.
Yeah. I think that's a really good starting point, because there are so many pitfalls and so many bad practices. If you're at least aware of them and you plan to avoid them, you're already doing better than most.
Yeah, hopefully.
So what I like about your journey is that if I looked at your LinkedIn, it looks like you've been in the same company all your life or your career, but actually you've had multiple entrepreneurial steps inside.
Mm-hmm.
How much of that, and even growing something from nearly nothing to 500 people, how much of that gives you empathy towards the entrepreneurs that you're here to serve?
Yeah, tons. And I mean, it was hard for me, and I was doing it with the resources of a Deloitte, right? The brand of Deloitte, the safety net of, if this venture doesn't work, I still have a job.
Mm.
And so, like, 100% tremendous empathy for entrepreneurs. I would say also just, my family experience and seeing we saw the super high highs and then the super low lows. And we lived that personally. And so, yeah, I think that also provides me with tremendous empathy, which is important, I think, when you're in this type of role, right? Founders really want to associate with investors that can understand them, can understand their company, can understand what they're personally going through. And so, yeah, I think that certainly serves us well in getting into companies that we're interested in.
Very nice. Another part of your journey, or in a way, a very important background and discipline for a venture capital firm, is your experience on valuations. And of course, it was from M&A, which is probably more late stage and early stage. But can you talk about how much of that is helping and how much of that could be filters?
Could be which filters?
Yeah, which means you have these filters of valuations probably from late stage, but when you look at early stage, maybe some unlearning is needed.
Yeah, yeah, you said it best. It was hard for me to wrap my head around the valuations in venture, because it is very different from what you're taught, on a free cash flow basis. There are no cash flows here. They're negative cash flows, and yet still they're worth a lot of money. And so there was a ton of unlearning, and different approaches, frankly, that need to be used, entirely different approaches than what I was used to in doing the valuation work that I did for a number of technology companies. It's more on the exit opportunity, the potential, the total addressable market. It's, I think at the first couple deals, my venture background, my valuation background was sort of it was hard. It was harder for me to get my head around what these valuations were. Thankfully, we've come a little bit off of what those valuations were when we started. And so it's getting more reasonable. And obviously, the process is quite a bit different.
Now, clearly, when you invest, it's part of your partnership. So everyone in Deloitte, Canada, is probably vested in the financial returns. So when you think about valuations, do you have any tips you can share with the audience about what you've unlearned, what you've learned, while keeping a financial discipline?
Yeah, it's a good question. I think capital efficiency is like one of the most important things. I'm like super glad to see sort of a return to fundamentals and a good use of capital by founders versus what we saw 18 months ago, which was growth at all costs. Frankly, I mean, it was, I think, irresponsible at times. And so, yeah, I think understanding those sort of SaaS metrics is really, really critical, and how they progress over time is something that we look at as part of our sort of valuation thesis on a company, versus, the discounted cash flow is just not obviously not something you can even use, not helpful. Yeah.
I think capital efficiency is also very important for dilution moving forward.
Yeah, absolutely. Absolutely.
One thing you said, which I really like, is when the CEO approached you, the first word you said was about how can we differentiate? And it's very interesting because most times people just want to do it, but they are not even thinking about how to differentiate. They just want to go and get going. And it sounds like you were very thoughtful about how we're going to be different and bring value. Can you share about what was your initial idea of differentiation and how you ended up with?
Yeah, and so we went out really to market at the time and spoke with a lot of companies to understand what they thought of Deloitte. Are you interested in Deloitte as an investor? Like how they think about corporate venture capital in Canada. There aren't many, right? Do you think we're slow and we can't get on board in enough time? Or, do we really add value? Do we hold you back and just want to buy you at the end, right? And we found that overwhelmingly there was a very positive reaction to Deloitte. And I think that's mainly because we partner with a lot of technology companies. A lot of them are later stage technology companies. But, I was even surprised to learn that almost 50% of our revenue in Canada is what we define as technology enabled. And so that includes services or solutions that we offer to companies that include the provision of a third-party tech vendor as part of that solution. And so more and more, there's this need to integrate earlier stage innovative solutions so that we can differentiate and provide, awesome solutions to our clients' increasingly complicated problems. Sure. And so and companies recognize that. They see us as, you're not a traditional corporate VC where you are the single or have the potential to be a single client. We unlock all of corporate Canada, right? And so it's a distribution angle that just has an amplification effect that companies just understood. They honestly didn't need to be told or taught or anything about it. It was like, you could get us into all your clients. I was like, yeah, we could. So that is the differentiator that really the market saw us as. And it's true. That's what we continue to hang our hat on. The other elements of it also include the ability to use it ourselves. I think some companies look at that. Some technologies are fit for that. Some are not. And then in other cases, the other value that we provide is, or in addition, it's not binary or either or, is expertise. And so as a professional services firm, we have experts in every discipline, really. People think of Deloitte as a tax and accounting shop, but reality is our consulting and advisory and technology business is equal size to those and growing much more rapidly. And so we can advise on product, on go-to-market, on talent acquisition, human capital, IPO readiness, tax, et cetera. And so vending in that expertise to our portfolio companies as they're working through various sort of scale up challenges and opportunities is also proven to be really valuable.
Now, of course, this is a planned differentiation and it's nearly obvious it could be very valuable to the portfolio companies. But then there's probably a lot of design decisions and execution to deliver on that superpower, on that promise of distribution to markets, using it inside, expertise. How have you designed Deloitte Ventures to deliver on that promised differentiation?
Yes. So Nicolas, I don't know if it's my internet or yours, but you're cutting out a little bit, but I think I got the gist of your question. Oh. The reality is it's hard. It's probably a lot harder than I expected. I guess I expected, and to your earlier point, like Deloitte partners are inherently investors in our fund. And so, I expected that they would have a vested interest in making our portfolio companies succeed. The reality is, we're a minority investor. And then they're, within 550 partners, a minority of that, right?
Yep.
And so the direct impact to a partner is quite limited. And that's not to say that changes anything, but your livelihood is based on what you drive with your clients and your sort of book of business, and that's where where partners focus their time and energy. What I also thought and expected, and what we are seeing hold true, is that we bring the experts in a particular domain. So let's say we're looking at a company in cybersecurity. We operate the largest cybersecurity practice in Canada, and we serve clients, so we understand the demand engine of what's happening in cyber. We also have partnerships with a lot of technology companies in this domain. And so we know what's out there in the market. We know where there are gaps. And so we leverage those we call them subject matter experts or adventurers, to help us in the diligence process. And what we're trying to prove in that diligence process is that this company is one of the top 3 companies for this particular use case. And when you can answer that question, then you have sort of a 1 in 3 chance of kind of, should that opportunity arise, being brought to their client. And so you start to create this inherent stickiness because they just love the tech and it's solving a problem for their clients. And so that's the angle we're really trying to pull on, is we're solving a need for your clients. You've validated that it's a proven need for your clients. And now we've all together found the solution. And so that should create the flywheel sort of on its own. And we're seeing that absolutely does work.
I love it. And also, when you look for these startups, you already know there's a pain point, there's a need, there's a market for it. So you already come with true insights about a product market fit gap. And I love the adventurers term. So why did you choose adventurers?
Adventures. Yes. Nicolas, you're cutting out for me. Am I cutting out for you?
No, I can hear you very well. And I see you very well.
Okay, now I can hear you very well. Can you ask your question again?
Yeah, so I was saying I love the term adventurers. Maybe you can tell a little the story about why you chose that term versus another.
I don't know. It just came to us. I thought it was really cute and cheeky, and we actually just put out a newsletter to our community as the first one, and we did it for Valentine's Day, and we called it "We Love Adventurers." It just, we just got to continue tipping and nodding our hat to the broader Deloitte that is really enabling what we do here today, right? Without our partners being engaged, we wouldn't be able to live up to our value creation promise, which then ruins our reputation and getting into deal flow, right? And so we have to live up to that. And so just continuing to show gratitude and bring them in and give back to them, right? So it not necessarily always asking them to pull our portfolio companies in, but sharing insights as we come along, things in the ecosystem. We prioritize doing that with sort of key areas where we have developed insights and relationships and partnerships in the market, namely 6 verticals. So we focus our investing efforts in fintech, cybersecurity, climate and sustainability, the future of work, data and AI, and health tech. And so we've created kind of adventurer champions for each of those verticals. And we meet at a different cadence. Some meet biweekly, some meet quarterly, where really we're trying to offer them value as well, so that we continue to create that stickiness. Trying much more of a pull approach. We're trying to get them to pull us in versus us sort of pushing our portfolio companies.
That's very nice. And I think it's a golden nugget for the audience, which is finding these internal experts could be just through a newsletter, and people just come, volunteer, are interested, which is kind of a very nice way of being sure they are motivated because they respond. But you also mentioned to keep them engaged. And here I feel like there is maybe some tips you can share about keeping this initial interest to help and nurture it.
Yeah. Well, going back to just the thesis of why we started this, we obviously there's a financial need here, but we talked about how this contributes to our strategy of finding new and innovative partnerships. We talked about how this fuels our clients by bringing them the latest and greatest. And then people was a big thing. Venture, 2 years ago when we launched this, still today, maybe less than it was 2 years ago, but super sexy. Right. And everybody was like, oh, Deloitte Ventures, I want to be part of this. Reality is we're 5 people, but we wanted to live up to our promise of attracting and retaining talent within the firm. And there's many ways to do that. And so the one I talked to you about, the adventurers and keeping people in the loop, is one. The other is involving them in events. We're now doing, we call it bite-sized adventure programs, where we have sort of drop-ins. We're going around the country and we're doing, hour and a half sessions on how we invest, deep dive into our portfolio company. What do term sheets look like? Like, we've got a corporate finance practice. We've got, people who are just interested in further understanding this area of investing, either personally or professionally or whatever it is. And so we offer that. We're also exploring ways we can, potentially second people to our portfolio companies. So, portfolio companies are one of them is looking to scale rapidly, wants to hire 100 engineers. We've got a massive pool of engineers at Deloitte, right? And so is there a way where we can second people to them for a certain period of time as they get through their build cycle? And so there's different models like that to be able to pull on and really amplify the impact that we can have with our people at Deloitte beyond sort of the 5 that work in the team. And we're continuing to find new ideas. And welcome any that you have or have come across in your travels.
Actually, so the secondment, we looked at it at TDK Ventures, but it hasn't yet worked out. And so I'm very interested to know how you managed to make it work. And here the challenge is, we don't want to charge the portfolio companies for that secondment, but at the same time, these people are expert and very busy on other projects. And then there is IP consideration. There is concerns about just coming for maybe 20 hours and then it's not enough. How do you manage to structure the secondment in a way that's valuable for Deloitte and is valuable for the portfolio companies?
Yeah, and so we haven't actually done one yet on a secondment basis, but yeah, it's got to be a win-win for everybody. And so, we would at least cover costs would be where I would say would be sort of at least a good starting point. But what else we do, again, you're cutting out a little bit, so I don't know if I heard the entire question, so apologies if I'm not answering it entirely, but to engage our people. So we don't provide Deloitte professional services for free, right? It's not like you're a portfolio company and so we're going to do your taxes, right? That's not a thing that we do, but we will provide you with expertise for a few hours from a partner who lives and breathes this particular space. And so they will tell you what to look out for, what to, if you are going to take this to market, what you're looking for in a vendor, those proposals generally have a lot of insight in them, right? And so they're not proposals, it's a discussion where we share insight. And what we do at Deloitte, because our partner is much like a law firm where you have billable hours, right? And so to get a partner to spend 5 hours or maybe an ongoing mentorship or whatever with a portfolio company is taking time away from where they could bill. And so we have created, as part of our operating budget, an ability to fund internal time.
That's a golden nugget here. I think that's really, really good because it's part of the value add you can bring specifically to the portfolio companies.
Yeah. And so we pay them. And so it's like, okay, you need some tax expertise. We're going to pay our tax team a few $1,000s so that they can then provide our portfolio company with that advice. The reality is, the funny thing is, while we have budgeted for this 2 years in a row, a fairly decent number, I think one time I was actually asked for it. Our partners are delighted by spending time with these companies and feeling the impact and the purpose and the meaning behind their advice and their work in a very different way than, serving the largest companies in Canada, right? Which is where they spend most of their time. So partners actually really enjoy it. And so that comes back to the people aspect, right? And we're engaging our people in a different way that just truly excites them.
To me, it is a sign that you are building champions inside the mothership.
Yeah, absolutely.
Now, earlier you mentioned about some of the issues that entrepreneurs shared with you, like CVCs can be slow. How did you work on this challenge to make it faster or appropriate for entrepreneurs?
Yeah. So we are not slow. I can say that we did 4 deals in 4 consecutive weeks at the
Wow.
beginning of last year. We can go from sort of first meeting to funding in as little as 6 weeks. And so we have just created a process. We're like really thoughtful about governance, of course, but we streamlined an investment committee that's purposefully small, but contains the key players in our firm. So we've got the chief client officer of the firm. We've got the chief strategy and innovation officer. We've got the chief operating officer, and a new one that just joined in the last few months is a disruption officer. So it used to be 3 and now it's 4. And we have in our calendars every 2 weeks, we've got 45 minutes set aside for an investment committee meeting. I mean, it doesn't happen every 2 weeks, so they get canceled, but we have the time reserved in these people's calendars because it otherwise be very hard to get. We preview things with them in advance. And then we have an investment committee, and we have delegations of authority. If we've got to kick it up to the board level, depending on a certain threshold, then we can do that. And we have lines into doing that quickly as well. We haven't had to do that yet, though. And we've got the whole sort of controls process, the legals, like we've got everything kind of templated and ready to go. And I would say, I mean, our first one was maybe a little bumpy. But yeah, I mean, each time we work out the kinks and it gets smoother and smoother and smoother. And that's one thing that I don't think none of our portfolio companies would say that we're slow. Like we've never held up a process.
6 weeks is not slow, even for a VC firm, let alone a CVC. And for the investment committee, 3 members, now 4 members. Are you looking at majority, or everyone needs to say yes?
Majority.
Yeah. So with 4, it's 2 votes, which is the same as when it was 3 votes.
Yeah, I guess so. We've never had an issue where there's a dissenter. It's all been unanimous so far.
There's a lot of views that actually, if you have dissent in the investment committee, it's probably going to be a very good investment.
Oh, interesting. Okay.
Because it means that the investment is not as obvious yet, so it's not like everyone believes in it, and therefore it has more potential to be an outlier than not. So I'm not sure if it's true, and I think we shouldn't look at the statistics even inside TDK Ventures, but dissent is not necessarily a sign of weak investment.
Good to know. Great.
So, well, good to know. I'm sharing what I'm hearing from other VC firms, colleagues, but I can see why, if it's not yet obvious, you wouldn't get a full consensus. But that doesn't actually mean it's a bad thing.
Totally.
What else did you design for your CVC that you're proud of?
What else did we design? Well, I mean, the team, I'm pretty proud of the team that we've built. It was clear, I mean, as I told you in my journey, I'm not a VC investor. And so, one of the things I flagged at the outset was we needed really strong VC expertise to marry with the, subject matter expertise we have as a firm to really create that superpower, right? And so we went out and I'm delighted by the expertise that we got. We have John Wolkin and Jay Crone. They co-manage the investment team. They're managing directors. One's in Toronto and one's in Vancouver. And they worked for one of the most active corporate venture funds in Canada. And so they understood not only, venture investing, but the nuance of corporate venture investing, which I think was really important for us. And they were able to bring all of that greatness to what we're building here. And then we've hired 2 senior associates from there. And then most recently, we just hired probably about 6 months ago, what we're calling a value creation and operations lead. So as our portfolio continues to grow and scale, we need to scale. My role on the team, or one of my roles on the team, is really to tap into the power of Deloitte. Given I've been here for a while and understand the different, intersection points, but we're really looking to scale that, right? We now have 6 portfolio companies, and, in another year we'll have 10. And so we have this value creation lead that's intended to help us scale that program as well. So yeah, I think that's worked out very well, and attracting them to Deloitte with the right sort of compensation models and all of that was, I think, really important too. We were very thoughtful in terms of how we dealt with that. I think it's important that you have some kind of hybrid of incentive that is both related to the performance of the fund, but also the success within the mothership. And so I am very proud of Deloitte, actually, in sort of seeing that, and creating something that makes sense.
Very nice. I'm not sure how much you can share, but what are the good ideas on the compensation front? Especially you mentioned a hybrid, which I think you mean it's both financial, but also the strategic element being rewarded. Is there any tips or good ideas that you want to share with the audience?
Yeah, I think just explicitly that, like, try to mimic a plan that really pulls on both of those things. Yeah, can't say much more than that, but I knew I was going down a rabbit hole on that.
Exactly. But I think you're right. I think the hybrid or having both sides being rewarded is really important, because if you only reward one side, then the team will just follow wherever the awards are. And that makes sense. It's totally normal. So having both sides, which is in line with your why, in line with your superpower, makes a lot of sense. I want to double click also on the value creation lead, especially it's recent, but you did it when you had probably 4 or 5 portfolio companies. Why the timing, and how did you choose that person?
Yeah, the timing, well, it was sort of twofold. I mean, there was one individual that was more of a chief of staff that was kind of playing that, but also helping develop the strategy on what this was going to be. He moved on to be the COO of a startup. And so it was time to create a new role. And I wanted to create, now that the strategy of what Deloitte Ventures is sort of not gone, but, not as prevalent at the moment. And so wanted to bring somebody on to spend more time on the portfolio. So that's the timing part. In terms of the qualifications, it's hard. There's a lot. I mean, there's lots of different people that could be capable of doing this and qualified and excel in this kind of role. We really look to a few areas in our firm. We've got actually have a group called Value Creation, and we've got a strategy group, and so we really leaned on those functions that are looking to help companies improve their value, whether it's on the top line, on the bottom line, etc. But also a passion for technology, I think, is really important. I think empathy is super important. I think a self-starter, sometimes it's not obvious what exactly we should be doing. And so trying to figure out, what makes sense. Somebody who has just an ability to prioritize, right? Because Deloitte can say, okay, we've got 50 opportunities for your portfolio company. And I mean, we could literally kill a company with that.
I was going to say that.
And so it's about triaging and understanding the likelihood of success in those opportunities, and only bringing forward the ones that really have a strong likelihood of success forward. And then I would say what's become apparent to me in the last couple months is somebody who's kind of firm, I think is important, because startups, they work in like hours and days. It's like, yeah, you want to meet? You want to meet tomorrow? You want to talk now? What, like, when can we meet your client? We're ready tomorrow. And Deloitte's like, okay, we'll talk to you in March, right? Like and Deloitte feels in many cases we've opened up, 4 or 5 clients for this company, and this company would go, well, we've been with you for 10 months, 4 or 5 companies, not enough, right? Founders always want more. That's the great thing about them, right?
Yep.
And so I think making them recognize that, we all the partners who are helping here have full-time jobs, and that there has to be a level, and I can handle the give us more all day, but when it goes to the adventurer and they just feel like they've opened up all their networks and they've done all this hard work and there's like zero appreciation like that, they'll stop giving. Right. And so managing that, I think is important and takes some level of gravitas and temperament and all sorts of soft skills.
I would even say that part is probably the most challenging. And maybe not so much for Deloitte, because I think your partners are already working with the entrepreneurs anyway as part of their jobs. So they may have more appreciations. But for bigger companies where people are not exposed to startups, there's really a mismatch sometimes between expectations of the entrepreneurs and the mothership. But even then, I'm sure you also have to manage that. So how do you manage both the expectations from the entrepreneurs, because they may expect everything and you have to set the expectation, especially if they're very early stage? It's not like you can open all the clients when it's too early and still prototyping, at the same time as setting the expectations with your partners.
Yeah, and I can't claim to have nailed this yet. We're obviously still learning. I would say with the founders, I'm very transparent. I just believe in full transparency, and our whole team really lives by that. And part of why we focus where we focus, which is I realize we didn't get into this, but Series A and B stage funding rounds, is because it is too early at the seed stage or pre-seed stage when you don't have product market fit. And so we didn't want to create that friction. Having said that, of our 6 companies, 2 were seed stage investments. So, but we told them that, like, it's quite challenging for Deloitte to work with an early stage company when you haven't validated product market fit with enterprise clients. Once you've been able to prove that, and we can rinse and repeat, and there's a model to go after, that's a lot easier. And that's not to say that the other stuff's impossible. It just takes a lot of conviction and a lot of investment and a lot of time from a partner or a group of partners who believe in a particular area, right? And they also have to, not just they believe, they have to get approval effectively from their leaders to forego generating X million dollars of revenue over here in hopes of building something over here. Effectively, they're trying to get carriage for being an entrepreneur within Deloitte, right?
Yep.
And so that doesn't always happen. So those are few and far between, and that's sort of why we invest where we invest. And then in terms of the size of our investment too, there's been there's, I guess, some more core deals that are larger checks. And there's some kind of what I'd call sort of toehold investments for subsequent rounds. And so we made it clear on those sort of toehold investments that, you don't get all of Deloitte today, right? We're watching, we're monitoring. We've placed an investment in you to perhaps increase our stake in a subsequent round, at which point, when you are a core deal, we will unlock these things. But yeah, I think it requires constant reminding on the things that we have done and to be patient with us. And, we try to really just focus where we can have impact. Right. And so we're not going to introduce you to 10 companies and, one's going to yield. We're going to introduce you to 4, and 3 out of the 4 are going to hit because we've pre-screened and pre-qualified them. And, we're making good use of your time. And so that's, I think it's quality for us over quantity.
I think
Yeah.
you have a very good plan to leverage your superpower. And as you deliver it, I think the entrepreneurs are going to love it and talk to other entrepreneurs. So I can see how this is going to be like a snowball, keeps improving and keeps doing better. And at that point, even investing early stage is okay because they know that when they are ready, you can deploy that superpower. I want to go back a bit to the time where the CEO tapped your shoulder and said, please check if it makes sense to do a CVC. Can you remember how you pitched it in a way that set the right expectations across Deloitte? Because it's easy to pitch something unrealistic and get it approved and then it fails. But to pitch with the right expectations, I think is very, very hard. Can you maybe share a bit of the inside of how you proposed it?
Yeah, it was fluid. So I came back. It was more of a working group. I came back and kept presenting sort of my findings to this executive leadership team. I think probably about 3 times. Should have been 2, and we were going to be off to the board to get approval. But I realized in that second meeting there was a misalignment of the why. You had a few people in the room talking about, we're going to find the next snowflake and we're going to have a preferred alliance relationship and we're going to generate revenue working with these, right? That was the prize, was the revenue we were going to generate in selling with these companies. And to me, and in all the work that I had done, that was not the prize. Again, to the point of, depending on the stage you're investing in, it takes a really long time to get that up the maturity curve to where that is a material revenue number. But when you think about returns and the multiplier effect on revenue and the investment that you have in that, and the fact that there's no margin to that, that's just pure profit, like that's where you start to really create, value for the firm. Versus applying a, system integrator type margin to some revenue, right? And it evens out. Yeah, you got right. And so I needed some degree of alignment on what that was and what the hierarchy of those benefits were, because that was going to impact how we structured, how we rewarded, how we evaluated, like everything. Right. And so it was so fundamental to, I think, how we built the fund that I kept pushing to understand and make sure that we're all on the same page. And that's where we landed. I mean, it was to build resilience for our firm. So we're a professional services firm today. This is about, hedging against disruption, both of our core business and of our clients' core business, while staying closer to technology and building a profit pool from investing. And this profit pool is going to be material. What we don't want is some little, 3 people over there doing some venture investing, and maybe every couple of years they kick out $5 or $10 million in the grand scheme of Deloitte Canada. That's not material.
Yep.
Right? We want the partners, when we have a home run, we want to be able to, earnings that year are materially different because of what happened in ventures. And then you start stacking funds on top of each other, and you have this really material, almost 7th business in our firm that is ventures. And so that's the vision for what we are to become. While also along the way, while you're in the bottom of the J curve and forever, but while you're not producing financial returns, you're going to produce a ton of strategic value. You're going to provide insight on what's happening, what's disrupting us, again, what's disrupting our clients. You're going to find new and innovative companies to work with. You're going to create innovative solutions for your clients. We're going to engage our people along the way, and we're going to support the ecosystem. We're going to invest in the latest and greatest technologies influencing and impacting the Canadian economy, and supercharging job creation and all that great stuff. And so there's financial, and then there's strategic.
Yeah. And I think there's a golden nugget you're sharing, which is make sure you deliver strategic value quite quickly so
Yeah.
that you're not being challenged while you're on the J curve and the financial returns take time. I mean, statistically, for a VC firm, it takes 7 years to return a fund if they ever return a fund.
Yeah.
So you have to show the value before that.
Yeah, absolutely. But what I didn't want, and I think one of the criticisms you've probably heard of corporate ventures, the ones that are solely strategic, I mean, it's hard to measure some of this strategic value, right?
Yeah. Yeah.
And I mean, we've created a scorecard that has a bajillion things, and so we're doing our best at measuring and quantifying each of those different values. But when times get tough, it's very easy for people to say, okay, well, that's not really enough. Um, versus there's we're going after a very big financial prize here that will be quite material. And at this point, we're a third of the way through it, so we're gonna hold the line.
Now, you intrigued me because you mentioned a scorecard for strategic value. So I feel like there is a few best practices there. Can you share what is this scorecard, what it includes, who you share it with?
Yeah, so it's a scorecard that has 5 pillars. It's got sort of strategy and insights. I think it's got sort of brand and network and ecosystem, financial, which includes in the early days, revenue, and in the later days, obviously returns. It's got client impact. And this is not just what we're noticing is our connectivity to the tech ecosystem and the venture ecosystem is being leveraged on engagements with clients. We have helped companies in Canada stand up a corporate venture fund. We have 2 mandates like that. So we're actually finding that it provides us, it catalyzes the professional service side in a different way than we expected, not just partnership. And then finally, it's sort of our country and our community. How many jobs have we created? What's our diversity and inclusion scores? Are we doing anything on climate, et cetera? And each year, the percentages in each of the categories will change. As you get sort of to the later years of the fund, the financial quadrant will be a material percentage.
Yep.
And within each of those, there's a whole bunch of metrics. So number of clients engaged, number of thesis papers shared, number of events spoken at, et cetera, et cetera. So there's lots of stuff being pulled into this scorecard. We produce it twice a year. And it all tracks up to a single score, like an index. So if you're at sort of 1, you're on track, etc. And we share it with our board. And so we report into the finance and investment capital committee of our board of directors of Deloitte Canada. And twice a year, we share this scorecard on where we're tracking.
Okay, it's very, very thoughtful. I'm glad you shared. I also like the fact that one of the pillars is societal impact. That's actually really good to have from the very beginning. One thing that many CVCs claim, and I think you are very intentional here because you haven't talked about number of papers and so on, is about sharing insights. Yeah. How did you go about sharing insights and tracking the impact of sharing these insights?
Yeah, so the tracking of the sharing of insights is kind of easy in terms of the number of thesis papers produced. But the reality is you're sharing insights every day, right? And you're making a connection between a partner and an early stage company. You're connecting somebody to a venture fund who has insights. I, connected one of my clients with one of the venture funds who invested in a company in a space that they're looking to acquire a company in. And so they have, a wealth of knowledge about the risk, fraud, and compliance space that they offered to share with my client. There's things like that happen daily that are really hard to measure, which is why I think when you anchor on strategic value, I'm just going to write a 50-page memo of all the times that we shared something with somebody. So it's actually really hard to identify all of it. What we have done through this scorecard, I think we have measures of it along the way, right? And so then on the client side, we've got opportunities enabled. And so we have in our, CRM as a firm, we have an ability to tag things to Deloitte Ventures. Deloitte Ventures has, contributed to the proposal. Deloitte Ventures provided you with this client, right? We do a lot of grant and incentive tax work, and we've provided them with a huge funnel of potential clients. And so tracking the, revenue opportunity and then conversion of that, is another way that we do it.
That's for me a golden nugget, because we want to also track the impact, and same for tracking revenue impact and profit impact, but we're trying to do it ourselves versus from the CRM tool of the mothership. And here you're saying actually it's part of the mothership CRM tool where they tag Deloitte Ventures, and therefore they could track your impact, which is, I think, very, very smart to do.
Yeah, so it's easy to run, right? Like twice a year, we just pull CRM with everything that has the tag, and you have the number. So,
okay, then I've learned something that I should discuss internally with TDK, which also is maybe one thing which I think you haven't said, so I need to ask, which you have these 6 portfolio companies, which clearly you're introducing at the right time with your partners. But you're going to see startups you decide not to invest for one reason or another, but you still believe could be valuable to your own clients. Is that the value creation lead that's also introducing these startups you don't invest in, or how do you handle these introductions?
it's typically one of the lead investors that will do it. So they know, again, within the verticals that we invest in, they've got those communities of practice. So let's take human capital as an example. And there's a particular area of human capital that our firm is interested in, but us ventures may not have a high degree of interest because the size of the total addressable market, whatever it is, stage size, could be much later stage. And so we just we send it to our, any of the leaders in that practice and said, hey, we heard you're interested in this or that, came across this company. Do you want to meet them? And they say yes or no. If they say yes, we just introduce them via email, and we just sort of walk away from that typically. Mm-hmm. We don't spend a lot of our calories and our value creation time following those interactions through, unless, of course, it's an earlier stage deal we're excited about. It's just a little too early for us, but our partners may be interested, in which case, and we're tracking for their A or something like that. In those cases, we'll stay closer to it.
But what's nice with your system is even if you don't track, it's going to be tracked on the CRM tool of Deloitte because you're tagged on the introduction to start.
Correct. Yeah.
Very nice. I want to talk a little bit about Canada. So we invested in Canada. We have 2 portfolio companies, Vuriol and PH7 Technologies, great companies. Can you share about what you see as maybe the SWOT analysis of Canada, the strengths, the weakness, the opportunities, and the threats?
I think I heard the question. There was a lot of cutting out. I think it's just about Canada and where we're at, or
yeah, what are the strengths and weakness of Canada in terms of ecosystem for entrepreneurs, and what do you see as the opportunities, but also the threats?
Okay, I caught some of it. I will try. So yeah, I mean, Canada's super innovative ecosystem, particularly for AI. We've got a number of universities that produce amazing engineers, and so the AI talent in Canada is amazing, and the engineering talent is amazing. So it's a great place to start a company. The grants and incentives that you get from the government also quite strong. All of that is really working in our favor. I would say the venture ecosystem is less mature, obviously, than the US, given even the relative size, like within our country. And so what we see is US or international investors sort of flying into the Canadian market and investing in Canadian companies, which which is great. I mean, we like some of that, right? Because you want all your companies to go global, but you sort of want them to retain their headquarters in Canada. Because what we then see is a lot of jobs migrate from Canada, and the companies set up shop in Silicon Valley, and away you go, right? And that I think is very unfortunate, and something that I think is a huge opportunity for us to change in the Canadian ecosystem.
Very nice. Now let's talk about Deloitte Ventures. What are you excited to invest next? For the entrepreneurs who are listening, what it is you plan to invest in the next 12 to 18 months?
What are we excited about investing in? Look, we've done an investment in this space, but I know fintech is a bit dicey right now, but there's still so much disruption and digitization of that whole area that I think is really exciting. I think insurtech is a really hot space. I think wealth tech, the way we do private banking in Canada or wealth management is like archaic, beyond archaic. And so I think that's a really huge opportunity. Climate and sustainability, of course, lots of really exciting innovations and advancements happening there. We have not yet done a direct investment in any climate or sustainability tech solutions. We have invested in a fund that prioritizes that, but really continue to look for opportunities there. I think on the sort of supply chain side, and understanding third-party risks of your entire supply chain. That's exciting. Generative AI, I mean, goes without saying. We invested in a wonderful company. That was one of the seed stage investments we had to sort of pivot for, because by the time it got to the A, it would probably be too expensive for us. But it's more on the infrastructure side, and I'm quite excited about the infrastructure side of generative AI. This company is a compiler technology that basically improves the efficiency of large language models so that it requires less chips, which of course, there's a shortage of those, and less compute power, which obviously is expensive. And so we co-invested with NVIDIA, Google's AI fund, and Thomson Reuters into that company, and are very excited about what they're going to accomplish.
I'm actually very impressed with the list of co-investing partners, which also shows that you are showing your differentiation and the superpower you can deliver to the company.
Yeah, absolutely. I mean, we're working with a good brand, I guess. We have that working in our favor. Deloitte being the largest professional services firm in the world, and our brand certainly has a pretty stellar reputation that's synonymous with trust. And so I think that absolutely bodes well for us. And so that's went into the decision to not rebrand. And we just, obviously leverage that for Deloitte Ventures.
Very nice. My last question to you, from everything you've learned, what would you tell Talia when you started the project of building a CVC?
Sorry, I missed it. Say it again, please.
So with everything you've learned, what would you tell Talia when you started building the proposal for the CVC?
What did I learn that I would tell Talia when, what did I learn? I mean, I learned a lot of things. I would say, the most important learning for, I think, anybody starting a CVC is that alignment piece at the beginning. And it wasn't a lesson. We didn't have to learn from failure, thankfully. But, I think if we didn't push on that and we didn't have the clarity that we had today, it would be a different result for sure.
Absolutely.
And so that's the piece that I think, I learned it from other people, and I'm super grateful for that, for holding the line on that piece.
Yep, you did very well, and I agree. That was so important because everything falls from that alignment on the why. Thank you so much, Talia. You gave us many golden nuggets, and I really like your candid and very open sharing of your learnings. Thank you.
Thank you. Pleasure. Look forward to connecting soon. Bye for now.
So I'm ending the